When faced with literally thousands of various possibilities, it might be difficult to select a high-quality investment. When it comes to investing for retirement, there are so many options that it can be tough to select which path to take. What will bring not just growth but stability and will not drain your funds in the form of fees? There is a lot to consider in the decision you make, since it might mean the difference between generating market-beating returns during your lifetime or gambling your life savings. These choices will point you in the correct direction to selecting high-quality investments. These ETFs are not only excellent solutions for achieving financial independence, they also deliver positive returns and have low fees. Welcome to Cashflow Canvas, where we teach lessons about investment and money-saving techniques. If you want to make your financial future better, make sure to like this video and subscribe to our channel for the latest updates. Vanguard Growth ETF is aimed toward growth. It is appropriate for younger investors. It tracks the crisp U.S. Large Cap Growth Index, which selects large and mid-sized equities with growth characteristics over a long time horizon and with a higher risk tolerance. Investing in this fund means that a large portion of your money will be invested directly in fast-growing firms such as Apple, Microsoft, Amazon, and Tesla. As the saying goes, bigger risk equals higher gain, thus this fund will perform better. Over a long length of time, returns should be higher than what you'd earn with a general S&P 500. Technology is the largest sector, followed by consumer cyclicals. In healthcare, communication is essential. Apple has the most stock, followed by Microsoft. As is customary with Amazon and Tesla, total stock dividends are tiny and frequently non-existent, giving the fund a dividend yield of 0.7%. Vanguard Value Index ETF, VTV, tracks the CRSP US Big Cap Value Index, which includes over 300 different companies. It selects stocks based on numerous value factors or stocks that appear to be trading at a discount relative to their worth, as opposed to growth investing, which focuses on selecting firms with a strong future growth rate. Consider value investing to be similar to purchasing a steak at a store that is normally priced at $12 but is on sale for $8. Warren Buffett's value investing method has allowed him to establish a net worth valued around $100 billion. Buffett refers to this as cigar butt investing, which entails purchasing undervalued enterprises. Healthcare receives the most allocation, followed by financials, industrials, and consumer defense. United Health, Berkshire Hathaway, Procter & Gamble, and AB are among the top 10 holdings. The dividend yield is less than 3%, while the expense ratio is less than 1%. When someone mentions the market, they're most likely referring to the S&P 500, which has become one of the primary indicators of the U.S. economy. Investing in the S&P 500 is a wonderful choice for many reasons. When you invest in this index, you're acquiring hundreds of stocks from different companies in all market sectors, offering you quick diversification. Before a company can be included in the S&P 500, it must meet a number of criteria to ensure that it will be beneficial for investors. In general, the company must be a specific size, liquid, and have positive earnings, in addition to other requirements. Technology is by far the largest sector, followed by healthcare, financials, and consumer cyclicals. Apple, Microsoft, Amazon, Tesla, and Exxon are among the top 10 holdings. For the reasons stated, and because it is frequently all that is required to attain a comfortable retirement, investing in the S&P 500 may be the best single investment you could make. VOO has a market average dividend yield of roughly 1.7% and a 0.03% expense ratio. Vanguard Total Stock Market ETF, ETI, provides diversification with 4,000 distinct U.S. holdings, comprising small, medium, and large businesses. Many investors prefer exposure to smaller companies because they offer greater upside potential than behemoth organizations that remain basically stable. It is considerably easier for a small business to double or triple its revenue when compared to a large company like Apple, whose growth is limited but is more volatile and has a higher risk of losing money and going out of business. Amazon and Berkshire Hathaway have a dividend yield of approximately 1.7%, while the expense ratio is 0.03%. Schwab U.S. Dividend Equity ETF is a favorite among dividend investors due to its major concentration on high-quality stocks. When purchasing dividend stocks and ETFs, it is critical to exercise caution because these are potentially rewarding investments and frequently camouflaged as yield traps. When an extremely high dividend yield pulls investors to a potentially troubled investment, this occurs. The focus on high-quality firms, in addition to dividends, should deliver healthy growth as well as income with over 100 stocks. The financial sector has the highest allocation, followed by industrials and technology. Merck, Amgen, IBM, and Coca-Cola are among the company's holdings. The dividend yield is approximately 3.5%, with an expenditure ratio of 0.06%. Vanguard VT Total World Stock ETF tracks the FTSE Global All-Cap Index, which covers both established and emerging economies. It invests in both international and domestic firms, unlike many popular funds, which are concentrated in foreign stocks. It has approximately 10,000 separate holdings in the United States alone, with roughly 40% of them in foreign markets. Yet it still has many of the same holdings as U.S. funds such as Apple, Berkshire Hathaway, Microsoft, and United Health. The largest sector is technology, followed by financials, stable healthcare, and consumer cyclicals. Investors also obtain international exposure, providing further diversification, and they can participate in the expansion of emerging markets. The dividend yield is over 2%, and the expenditure ratio is only 0.06%. These funds differ somewhat, yet many of them have similar characteristics. Most of these are Vanguard funds, known for having some of the lowest expense ratios, and they are most likely equivalents offered by various companies because most of the major investment firms offer the same selection when you choose a high-quality ETF that is diversified and holds class-leading companies with solid track records. Fundamentally, there isn't much else you need to do. By investing in the fund on a regular basis as prices increase and decrease, you should see significant growth that will help your investments compound. A small selection, or even just one high-quality ETF, will be all you'll ever need to become extremely wealthy. As we conclude, I'd like to thank you for watching. I hope you found value in this video and learned something new, and I look forward to seeing you in our future videos. I would deeply value it if you could like this video and subscribe to our channel. Your support will help us to create more valuable content, and we can work together to secure your financial future. What are the key takeaways from this video that you can share in the comment section?